Before we actually get stuck into the question and answer session of the panel, we will try a couple of audience polling questions during the course of the session. If you want to take part in the polling, the details are there at the bottom of the slide in front of me. Log in at www.imn.org/polls, and the password is there, ABS04. Gentlemen, the topic we have is key regulatory headwinds for investing in ABS. I hope perhaps that we might, after last week's announcement, talk perhaps about tailwinds, or maybe having had a sort of slightly bumpy journey out of London with a wet and windy London this morning, perhaps crosswinds might be the most accurate term to describe the regulatory situation at the moment. Let's talk a little bit about where the market is just now as you see it. Martin-Jan, where do you see things as an investor?
Where's the ABS market at the moment? I would say the ABS market is still shrinking, mostly due to the fact that there is very little new issuance at the moment, very few new transactions. At the moment, ABS as a funding tool cannot compete with other sources of funding like covered bonds, central bank funding, which are definitely more cheaper and also less burdensome for most issuers. So the incentives, in my opinion, for banks and originator to issue ABS are quite low at the moment. And at the same time, for investors, the hurdles to invest in ABS are still relatively high. So, for instance, high capital charges for insurance in Solvency II, but also onerous due diligence requirements and reporting requirements for fund managers and banks. I would say the main investors today are banks, fund managers, and of course the ECB. Insurers have mostly been pushed out of the market due to the very high capital, the onerous capital treatment in Solvency II. And a nice example is, for instance, a 5-year AAA CLO bond with 40% credit enhancement, which attracts capital under Solvency II of about 60%. So that's very hard to make that work on a return on capital basis. So insurers' holding of ABS has been declining ever since the crisis, which was about, I think, 10% on average at the time, 2007, just before, and has declined to about 2 or 3% at the moment. So they have shifted to things that work better on the Solvency II, like investing in whole loan portfolios, which offer no first loss protection, of course, but have quite a favorable capital treatment, which, with, for instance, 5% capital for a Dutch mortgage portfolio. So to get them back, capital charges need to be lowered, and then I think still it will take a lot of time for the insurance community to go back to the market. They have to build up their portfolio management expertise again, and I think that's. They will only do that if they see a significant market pickup in issuance and relative value, of course.
So clearly a challenge there in light of the market conditions. Harry, would you agree with Martin-Jan's assessment?
I unfortunately, although it was a very sunny day and I was trying to be more positive, I unfortunately have to agree with him.
Mm-hmm.
I think.
Is the world a little bit different seen from the bank treasury perspective as opposed to the insurance perspective that Martin-Jan has?
Probably is different. Nevertheless, the regulatory hurdles added for investing as a bank treasury are definitely much stricter than they were 10 years ago. Mm-hmm. I think. Yes, I still can invest, but if you look how many issuers have decided to find different ways of financing themselves, this is becoming a niche market in its own. And unfortunately, my son is into watching the Jurassic Park series, all those things that nothing's supposed to go wrong, everything is regulated, everything is great. But there's a guy there, I think a mathematician, who says, well, according to chaos theory, life always finds a way in even a controlled environment to escape and continue to exist. And in the process of us being in the waiting room trying to get the operation in Brussels to work and fix ABS, life found a way, and cover bonds evolved to conditional pass-throughs. And ask people, what's the difference between a cover bond conditional pass-through and a master trust scam? And apart from the fantastic regular treatment for the cover bond conditional pass-through, capital-wise, no difference whatsoever. It's exactly almost the same. One, though, has a much better treatment. So if I am the life force of funding, I'll just go the other route. Hopefully, now that we passed the first hurdle, which was the STS issuance, we have to go to level 2. I'm not sure how long that's going to take.
Well, we'll come back perhaps to
But
STS.
probably
Let's come back.
yeah,
Let's come back to STS in a moment. I mean, Mauricio, from a rating agency perspective, where we are now, any thoughts on from wearing your hat at Kroll?
Sure. Thanks, Vincent. I think from our perspective, I would agree with what everyone has said, that it's extraneous factors that are causing the supply to be very low in this market. It's accommodative central bank policy, it's capital charges, it's competing products fundamentally that are causing issuance levels to be so low. From a credit perspective, actually, we're pretty bullish. The European economy is showing signs of strength. Most asset classes, I think, we're pretty constructive on. Banks are looking healthier, not all banks, but most banks are looking healthier, certainly healthier than they were a year ago. So the credit fundamentals are actually in place for this market to grow, but these extraneous factors seem to be the ones that are stopping it.
And there is supply there as well. There is product to be securitized as well.
Absolutely, yeah.
So there are some positives there, and let's hope that the announcement last week, the outcome of the trialogue, is one of those positives. I mean, do you think that it is a game changer for the securitization market in Europe, or is it too early to tell yet? Perhaps.
Yeah, I would say game changer is definitely too strong, but I would view the agreement as definitely a step in the right direction. Yeah, quite important. For instance, the 5% retention rule has been maintained, which is very positive for instance, the CLO market. With higher retention than 5% required, it would be the market would be definitely less attractive to issue for CLO issuers. Yeah, I would say also the adaptation of or the adoption of the STS framework seems positive. I think it's in general it's good to have one securitization framework in place rather than have multiple rules coming from multiple pieces of legislation. A lot will depend, in my view at least, on the effect of the new regulation on capital charges, especially on the insurance side. At the same time, at the moment, securitization for issuers is also quite burdensome in respect of operational liquidity reporting requirements. So, there's quite definitely some room for improvement there.
We'll come back one or two of those points. We'll come back to Mauricio. You wanted to say something on STS?
Sure, thank you. I was involved in setting up the covered bond label some years ago when it was first set up, and one thing was clear was that, as mentioned just now, that the capital charges are the absolutely key thing. Having a label, standardizing stuff is nice, but the ABS market is founded on heterogeneity rather than homogeneity, and so for me, standardization is nice, but the sophistication of the investors is such that I think most investors can handle non-standardized products. But if you add improved capital charges for bank and insurance holders, then that's the game changer. And without that, it's window dressing in my mind.
The heterogeneity goes against homogeneity, and is that not one of the issues, one of the handicaps the European markets had, that we are perhaps too heterogeneous a market? There isn't enough homogeneous product out there. I would have thought one of the really positive things about STS is it's pushing homogeneity and therefore making life easier for investors, leaving aside the other constraints which you've mentioned?
Of course. I mean, look, if you had to choose between homogeneity and heterogeneity, you'd take the former. But my point is that the investor base is sophisticated and can handle a fair degree of heterogeneity. But if you throw in improved capitalization, then that's a game changer, because actually it becomes cheaper to hold this paper, and it starts to look far more attractive versus competing assets.
Yeah. And Harry, I'm sure you would very much agree, given your previous comments on the capital treatment.
Yeah, I think, again, if you go 10 years back, you had a single ABS market in Europe. It didn't matter which European state you invested. Today is no longer a single market. Today you have a market that is fragmented. A lot of those markets, no new issuers or no issuers are issuing, or there's like one or two issues, which to me, one or two issues do not constitute a market. And again, I mean, there's several factors for it. A lot of it has to do with other programs and other priorities that the authorities have, which is to revive the market or the economy, not ABS. I mean, I don't think ABS is their interest. Interest is the economy itself. Having said that, I think having, again, level 1 legislation, ABS, is great. Maybe they're not the best legislation we can get, but it's good to have one. If it doesn't work 2 years down the line, we can try to fix what doesn't work, and as you do, adjust things. Hopefully we're still going to be around and we can do that.
Well, we've had a slightly muted response on STS from the panel. I'd be very interested in the views of the audience. I think the first polling question we were going to put to you is the same question I just put to the panel. Is in your view the STS proposals a game changer in Europe? And perhaps I could ask the technical team at the end at the back to put up the first audience polling question. If those of you who are logged in could take part, please. Looking at the team at the back, have we got?
Yep.
¿Nos puede poner la pregunta, por favor?
That would work.
There we are. Yes, great. That's pretty emphatic. Well, that I suppose picks up the tenor of the discussion on the panel. So we're not too far off. Yeah. Statistically insignificant. That's that's STS. Perhaps a view of the current proposals. But what about paper that falls outside that bucket, the non-STS paper? Are we going to find ourselves? You talked about fragmentation in the market, Harry, which is something I completely agree with, and I think fragmentation is something we're unfortunately going to see even more of now with Brexit as well coming along. But in terms of adverse impact on non-STS paper, is that something that we're going to have to contend with alongside the positive impacts or the potentially positive impacts of STS?
Perhaps, I think, yes, you're going to have, again, further fragmentation, further, even smaller parts, so even less liquidity. And I think that part there are two things. If it's legacy, we'll just take its natural runoff rate and die with it. Mm-hmm. And then you will create a new market that's probably non-STS, which is specifically meets the requirements of some of the issuers. I mean, if you look at the market, has gone from being a bank issuer market to non-bank on challenger or other parties. So I think that the market has changed completely to where it used to be. And maybe that's the new theme for ABS. It's just going to be the funding tool, but less for banks, but more for all the other guys.
Yeah. Well, we're certainly seeing one of the things we see at DLA Piper is is a real demand for the securitization technique amongst the new lenders, new entrants to the market. They are certainly interested in securitization as a form of financing, but they are constrained by a number of the features, the regulatory features and capital requirements of the current environment.
I mean, if we go back in time, I mean, the ABS as a tool is a fantastic tool. It actually solves a lot of the issues that you have. It provides a lot of solutions to amortizing assets, et cetera, et cetera, et cetera. But unfortunately, the tool has now been blamed for everything wrong in the world, and instead of blaming the usage of the tool, you're blaming the tool. And once you blame the tool, you have to start calling it something else, a covered loan or secured loan or something else. But the technique is used is exactly the same. Absolutely right.
If I can comment still on the, I think the introduction of the new regulation will certainly divide between STS and non-STS structures. And to some degree, you already see it in the market as investors, for instance, differentiate between a German auto ABS, which is pretty granular, and a single name CMBS. However, as yet, it's not cemented in regulation by a different regulatory treatment, except for Solvency II, which has the Type 1 and the Type 2 for capital charges. So if this will happen, of course, the STS structures will be less attractive for banks and insurers from a capital perspective, these non-STS structures. However, on the other side, for fund managers and pension funds, these non-STS structures can be, again, an opportunity to obtain an extra pickup in yield at the same credit risk, as they're not so dependent on the capital charges.
Do you think that's going to be how significant is going to be? Will that pickup be? Any thoughts yet about where that might land? Is it too early to say?
Yeah, I would think it's comparable between the pickup you see for a AAA CLO versus a AAA or AA UK non-conforming senior versus a German auto ABS. I think it will be in that range. Mm-hmm. It would be about 60 basis points at the moment.
Right. Okay. Interesting. In terms of from a rating agency perspective, do you see the STS, non-STS divide being of any significance, Mauricio?
No, not at all, actually. I mean, every deal you look at on its merits. So, depending on the creditworthiness, the level of data, the confidence in the data, would all be analysed on a case-by-case basis. So, just because a particular asset class falls out of STS or a particular originator, by virtue of its jurisdiction, falls out of STS doesn't necessarily have any bearing on the rating. Obviously, if there's a worse asset class and there's poorer quality data, then those are influential factors. But I don't see that as something connected to the STS-ness of the deal.
Yeah, great. I think the second audience polling question we were interested in is that question about whether non-STS bonds are going to be adversely affected by the proposals. Perhaps we could have the second. There we are. That's interesting that the two-thirds of you think that there isn't going to be an adverse effect. Okay, well, we'll perhaps come back to that towards the end in one of our last questions to the panel. Mauricio mentioned data being key ultimately to what he does and the rating agency approach. Of course, one aspect of the STS proposals is third-party certification, which survived the trialogue process, although without clearly the trialogue, the outcome of the trialogue is that the responsibility for certification lies with the originator and then with the issuers to ensure that the investors to ensure that the bonds are compliant. But there is a place in the STS environment for certification, and I'd be interested to hear from Martin Jan and from Harry as investors whether they will attach much importance to third-party certification in their investment decisions in a couple of years' time.
Yeah, I think it will be limited indeed, as I understood as well. The responsibility for STS certification remains with the originator or sponsor of the deal, even when a third party is involved in the certification process. I think the role of a third party, again, that would support verification compliance will be limited. From an investor point of view, I would say it would be good to have an independent party involved, but in my opinion, it's more a nice to have than a must have.
Mm-hmm. Harry, would you have a similar view?
I think it's actually useful, but for a different reason. You have a regulatory fill-the-box kind of requirement, and I think having a third party who will go through all these 52 points and check that they are actually met, for me, is useful. That will not change the way we do our due diligence, will not change the way we analyze the deals. I mean, also today I look at rating agency reports, but doesn't mean I take them face value. I read them, I look at them, I see whether they picked up something I didn't pick up, which sometimes they do. But in the end of the day, the decision of whether to invest or not is based on our analysis. And as I said, but having to manually go for 52 points and double check them, or I don't know how many criteria are going to end up in the end. I think it's good to have that. I think it's good to have that. At least takes out that me having to set up a team internally who does that.
Right.
So from that point of view, I think it's good. But you can't rely anymore on third party, at least for the investment decision part.
So it's good, useful, but of limited use, I think, is the answer.
I think without it would have been very difficult though to invest, because if I don't have it and I have to go through 52 points, how much time is that going to take? How do I get the comfort internally? So I think there is that use. Yes, it does allow you to invest without being afraid that you wake up one day and it's non-STS anymore, and that is because you made a mistake.
Yeah. Okay. Right. Well, the other aspect of data and in the STS proposal is the data repository concept, which again survived through to the final outcome of the trialogue. Is that something that you, either of you, or indeed Mauricio, see as being of benefit to the industry? Are you going to have regard to the information that's sitting in that repository, or repositories? I think, because it looks as if there won't be a single centralized one. It's likely that there'll be a number of data repositories offering that service.
I think from our perspective, from the rating agency perspective, we get all the data anyway. So I think the benefit will only be felt as investors who may not have access to that level of granularity at the moment.
Harry,
I think it's
any use to you guys?
I mean, I think it's like the European data warehouse. For me, particularly, is not useful because downloading 100,000 loans and checking through it requires a lot of time. But I have seen third-party users taking the data, using it, analyzing it, and then I can read that analysis. So I think that's very useful. I think this European depository, I don't know how different it's going to be for a European data warehouse. Maybe it has more data. But in the next 10 to 20 years, I think we're going to see the value of it. But it's going to take a decade, I think, before we can extract any a decade and a crisis. So I'm not sure which one will come first, right? Because you need to go through the crisis and get that data to be able to analyze. So
always the optimist, Mr. Nutzels.
I'll give it a decade, though. I'm quite.
I think, I would agree with that. I think the data, could be useful, and I think especially for mezzanine tranches or tranches lower in the cap stack, it would be quite useful to have loan-level data. But as Harry mentioned, for a large extent, we already have it in the European data warehouse, which we can use as input for stress testing tools. I'm of course it's. I think it's also more or less a nice to have than a must have again.
I must say my own view is very much, and I would agree on that one. Another key issue in a key decision in relation to the STS proposal is the inversion of the hierarchies, SEC, ERBA, and SEC SA, the standardized approach and the external rating-based approach, in certain contexts, which was being pushed for by some in the securitization community, but not by any means by all participants in the community. Do you think this is an important dynamic in the STS proposals? Harry, perhaps?
I mean, it shows you, depends what your vantage point, you pick and choose, but that exactly shows you the problem with those methodologies is that depending who you are and what you're securitizing or what you're buying, you have a different preference. And to me, the risk is the same. So if the risk is the same, the methodology doesn't change the risk because I'm using ERBA now, my asset has become more safe or less safe. And that shows you why we should have a discussion about those capital charges and those levels, because if choice of methodology changes the risk, apparent risk in a deal, then that does make a lot of sense to me.
Martin, are you fairly comfortable? Probably not something that makes a huge impact in your world. But Solvency II and the capital effects of STS will.
Yeah. Of course, that's very important. Yeah, I think the most important thing which can result from the implementation of this new framework is, for us, is what the impact will be on Solvency II. So at the moment, it's like I said before, insurers have been pushed out of the market, to get them back, capital charges have to be lowered, and then still you have to see to get them back because they're not used to investing in ABS anymore. They've reduced their expertise. Portfolio management capabilities have to be rebuilt. And I think it will only happen if there will be a big market pickup in terms of issuance and of course still the relative value has to be there. Mm-hmm. But the first step is to lower those capital charges in solvency.
Yeah, and make the product more competitive with some of the similar products we've been talking about. One of the detailed proposals that's come out over the last few weeks has been the proposal to treat non-securitization to treat securitization as special purpose entities, special purpose companies as financial counterparties for clearing purposes under EMIR. There is potentially an exemption for STS securitization SPEs, but although that's something that has been floating around in some consultation papers for some time, I think it's fair to say it came as a surprise to many people when that proposal came through a few weeks ago. I'd be very interested in your views about it and whether that's going to have an adverse effect on the market.
Yeah, I think this would be a clear negative for the market. Yes, this would mean strict requirements for margining, daily mark-to-market, strict reporting requirements, and potentially become subject to the clearing obligations for ABS. And at the moment, ABS are definitely not set up to these kind of requirements, and also in some cases cannot meet or comply with these requirements. I heard that covered bonds have been exempted from collateral posting under EMIR, so hopefully this will be extended to ABS as well, as these vehicles are not set up to comply with these type of requirements.
Any thoughts on that, Harry?
I hope it's just a typo slippage. Someone just was not informed that the world has changed and where ABS is good again. But it just shows you that still left hand and right hand not really talking to each other at all, always. So I hope it's a mistake. I hope it's just something that will disappear and will get the exemption as the cover bond. Otherwise, I'll just have to cover myself with something and change my name. Because become covered ABS, and then might get exemption as well.
Absolutely.
I mean, it begs you wonder if you have the word covered, it works. Otherwise, it doesn't. So we need to come up. Next conference should be about what is our new name, and then everything works. We get the best regular treatment you could wish for.
I'll mention that suggestion to IMN after the session.
Exactly.
Yeah. The other aspect of STS I'd like to mention is I'd like to ask you about is the whole question of third party recognition, which is not in there. I think the Brexit position, the Brexit negotiations, meant that any real discussion of third party country recognition was taken off the table. We've touched on briefly already the question of fragmentation in this market, and indeed in the capital markets generally, which I think is one of the sad consequences that we will have to deal with coming out of the Brexit situation. I'd be very interested in your views generally about this issue in the context of both STS and possibly more generally about Brexit and how you see this affecting the market. In many ways it's a quasi-regulatory concern over the next few years. Mauricio, I see you want to say something. Thanks,
Vincent. Clearly Brexit's a crazy idea, and I think most people in this room would agree. If you don't, let's have a chat later. I think broadly, UK issuers over the last 10 or 15 years have really set the standard for securitization. And so a lot of what we have in STS, ironically, are things that UK originators have been doing for some time. And the levels of disclosure are such that that there probably wouldn't be much for UK issuers to do to adhere to these standards. Much of that has been a result of issuance into the US for some time, and the more detailed disclosure required for SEC registered transactions. So from a credit perspective, from an analysis and data perspective, I think the UK in particular is probably there, or there or thereabouts. So there wouldn't be much needed to adhere to these standards. But clearly, we come back to the topic that we opened on, and in terms of capital relief, clearly UK securitizations wouldn't benefit from any capital relief under STS. I think the rules are fairly clear that that none of the involved parties can be outside the EU, that be the originator or the underlying assets or the SPV. So outside of STS, if there are meaningful capital benefits, then it may impact upon UK originators. That said, UK originators, as I say, have set the standards for securitization for many years and have very deep investor bases outside of Europe. And Europe hasn't traditionally been a huge investor base in UK product. They've classically looked to the UK investor base itself and also across the Atlantic to the US, and have developed that investor base very, very skillfully. So I don't actually see there being a huge amount of difference in terms of UK banks' ability to fund themselves outside of the STS framework.
Martin, Harry, will you stop buying any UK originated assets and with the onset of Brexit?
I mean, if you look at the European ABS market, the most vibrant market is the UK market, and then the next market is the German auto market, and then you have small bits and pieces left, right, and center. So by losing the UK, you're losing, I would say, half of the market. And I think what's an interesting statistic is that for the first time, you have more Dutch cover bonds outstanding than Dutch RMBS outstanding, where several years ago there was almost no cover bonds in the Dutch market. So that shows you that the other big vibrant market for ABS, which was the Dutch market, is becoming more covered every day that passes. So hence, my question is, we're talking about the European ABS market, and then I'm asking, if you take the UK out and Holland is not there, what is really left? Germany, a bit of Irish issuance? It starts becoming,
Italy, Spain?
Yeah, but how much issuance you see out of there? I mean, it's 2 issuers, 3 issuers. It's becoming, again, okay, you have the NPLs, fine, but it's one segment on its own, comes and goes, depends on the economy. It's just, you start wondering, can we talk about the European market anymore, or should we be talking about Italian NPLs, German autos, Spanish SMEs, if they ever come back, and that's about it. That is my fear, that then you have very specific investor bases for those assets. It's not the same investor base. It just becomes a very fragmented market. So
Yes.
yeah, it's sad actually to see that.
Yeah, I mean, I think you're right. There's a risk of kind of the market losing critical mass and investors kind of not bothering to focus on it because, you know, if you can't get a meaningful amount of paper in your portfolio, you're not going to dedicate the credit work to the asset class. I guess you just have to put faith in the STS initiative that it will stimulate more issuance.
I would put more faith in the ECB being less accommodative in financing in other ways, but I'm not sure when that's going to stop.
Yes, that is an interesting question. Martin, any thoughts on the
yeah,
UK
I would say
and
yeah,
Brexit?
I agree with Harry and with Mauricio because yeah, the UK ABS market is quite a large part of our market, and yeah, I would say it's also one of the more interesting part of the market in terms of risk return.
Mm-hmm.
So yeah, losing that would be definitely a negative for the market in which you which there's only German autos and maybe some French prime RMBS left. So yeah, that would be definitely a negative in my opinion.
Well, I think as things are set at the moment, it's going to happen. Although who knows what the situation, how the situation will look any different on Friday morning when we turn on the radio or turn on the television after the results of the election in the UK. Thinking about that, but time is nearly up, and I know the trustee panel will be keen to start at 1:15 fairly promptly. A last thought, perhaps jumping ahead 2 years to June 2019, global ABS here in Barcelona. Let's all hope. Brexit's likely to have happened in March that year as well. We might be in some sort of transition phase, but Brexit will probably have happened. The STS proposals, if they keep to the timetable, will have come into force July next year. How do you see the market in this time 2 years? Any little bit of crystal ball gazing, gentlemen?
Yeah, I would say a lot will depend on the impact on the capital charges for the investors to make ABS attractive enough to invest in. So that's the most important point in my view. At the same time, issuing ABS for originators, has to be attractive versus their covered bonds and LTRO or LTRO funding. And which is, of course, at the moment cheaper, but it's also less burdensome for issuers or for banks to make use of those type of funding. So there has to happen something as well.
Mauricio?
I think, you know, the trajectory from a credit perspective is good. So if you look at continental Europe, I think the economy appears to be emerging from the doldrums. So, you know, in 2 years' time, I would hope that from a macro perspective and from a micro perspective that the credit trajectory would have remained positive, and that, you know, the market will be in ruder health from that perspective. You know, if we can stimulate supply in other ways by diminishing the accommodative nature of central bank assistance and you know, if SDS kicks off, and I think all the stars will have aligned for a vibrant market.
Great. And Harry, any final thoughts from you?
Yeah, assuming that the regulatory framework becomes friendly again for ABS, and assuming that in 2019 the ECB is less accommodative like today, yes, I think there is a likelihood that a lot of the issuers who are now issuing for the TLTRO, so basically the transaction happens but doesn't become public, a lot of those issues become public, definitely will revive the market. But you need two things, the STS closure to be correct and the follow-up, level 2 and everything else, solvency to be done, and the ECB to have started withdrawing. They don't have to stop, they just have to start withdrawing their stimulus where issuers will have to come back and retouch the market. And if you have those 2 points, then I think, yes, we will have something to celebrate here.
So, ladies and gentlemen, I think coming back to my opening remarks, I think possibly tailwinds might be a little bit too optimistic. Headwinds, well, I definitely opt for crosswinds in terms of regulatory developments at the moment. Some good, some bad, but let's hope that we come through and do land safely. However bumpy that landing might be over the next 12, 18 months or 2 years. We probably have time maybe for one question or 2 questions from the floor, if anyone has a question at this stage in the session. There's one gentleman there.
Hi, everyone. I think Harry might have answered my question, but my question is the following. Don't you think that banks are more to blame than investors when it comes to the headwinds facing the ABS market? Because from my perspective, as an investor, obviously, I have the fundamentals. Maybe they're solid, but I have to add on that. I have to add the liquidity issue because banks are not providing liquidity. But when looking at banks, it seems to me they're just used to the cheap funding from central banks, and they're not willing to pay more for ABS, because at the end, ABS is just a tool to diversify their funding plan. And number two, obviously when you move to off balance sheet, obviously it's not a covered bond, and they need to pay up for that.
I mean, if you look at law of physics or a law of nature, always chooses the path of least resistance. And if the path of least resistance is cheap central bank or other type of funding, that's the path it's going to choose. I mean, that applies, it's a universal law, always the path of least resistance. That's why I'm saying the moment central banks become less accommodative, then you will see issuers opting to re-engage with the investor base. And I'm already seeing that. I'm already talking to some issuers and asking them, what are your plans, assuming ECB had stopped their program, stopped the TLTRO, would that change your issuance pattern? And the answer from all of them was, the moment they stop, yes, our issuance pattern will change, we'll try to re-engage with the market. They don't know when that's going to happen. That's why they can't tell me whether they're going to issue this year or next year. But the moment it happens, all of them, they will try to come back because that path would have closed. And that's unfortunately how nature works. And ABS is not different to that.
Great. Well, I think we are just out of time. So I'd like to thank my fellow panelists very much for their contributions today. And thank you all for attending. Enjoy the rest of the conference.
Thank you.